Welcome to Retirement GPS, navigated by Zynergy, your roadmap to a secure and confident retirement. Each week, we explore strategies, stories, and planning frameworks designed to help you navigate the complexities of life after work. From tax planning to investments, income strategies to risk management, our goal is to give you the clarity and confidence you need to make informed decisions. But retirement isn't just about the numbers. It's also about lifestyle, purpose, and peace of mind. We're here to guide you through both the financial details and the personal dimensions of this next chapter. Let's chart today's course.
Welcome back to episode 18 of our Retirement GPS podcast. I'm your host, Ryan Zaharchik, certified financial planner and president of Zynergy Retirement Planning.
And I'm your associate planner, Zane Belsack.
Welcome, Zane. Big day today. We're going to talk about a topic that we get a lot of questions about, whether people know that it even exists or not. A fair amount of people want to talk about it. So we decided to turn it into a podcast, and that is the topic of required minimum distributions. And we're going to call required minimum distributions RMDs from here on out. And RMDs are the distributions that we are required to take from our IRAs, 401ks, qualified retirement accounts, pre-tax qualified accounts when we hit a certain age. So we'll cover RMD basics, we'll cover common pitfalls, tax and planning opportunities, and really how to turn your RMDs into a long-term strategy. And there are a lot of things to talk about in this, so I'm really excited to dive in. I'm going to start with a story. We're going to change her name for the sake of protecting her identity, but this is Stacy. When Stacy came to us, she was a bit older. She was already well into retirement and already collecting her RMDs. Stacy was in her mid-70s, 76 when she started with us, but she had a very big IRA, and she was collecting enough from her IRA to satisfy her required minimum distributions just from her normal living expenses. She didn't have a very high lifestyle. She actually was living a relatively modest lifestyle for the amount of money that she had, but her IRA had grown to, at that point, about $3 million, and she was distributing already well within her RMD because her RMD was pretty low since she was young. Now, we've been working with Stacy for over 15 years now, and as Stacy's gotten older and older, her RMD has grown more and more. And it's gotten to the point where she's actually at a stage of her life where she's just not able to spend it. She doesn't travel as much as she used to just due to her health and her age. She doesn't socialize as much, go out to dinner, and do the things she used to do when she first retired in her 60s and 70s. So now the end of the year comes and we look at Stacy's RMD, what she has to take from her retirement account, and it looks as if there is far more money than Stacy needs. And what we wind up doing after we talk with Stacy is we literally take the money out of her IRA and we move it to a taxable investment account. We pay a huge tax bill. It pushes her into higher Medicare IRMAAs and higher Social Security tax brackets, all bad things, and she really doesn't have anything to do with the money. So it's a problem.
And that's a great problem to have. Nonetheless, having more than enough money to distribute is a good thing. In essence, paying more tax than you really should or have to in this case is really a problem.
And a lot of people will chuckle when I say it can be a problem down the line. You may have more money than you need. They'll say,
I would love that problem, but
who wouldn't love that problem? Love that problem right now. More money than you need would be just a fantastic thing to have. But, and again, you might say that's not a problem I want to even worry about now, but it does become a problem when you start losing control of your tax bracket. And we're going to talk a little bit about what that means and how that works. Let's define what RMDs are and when they start. So we talked about RMDs already in the context of Stacy. RMDs are the minimum withdrawal that you are required to take each year from a pre-tax retirement account. Let's talk about the concept behind it, because a lot of people get annoyed and they say, oh, it's just another way for the government to rip us off. And the truth is, it's the government saying to you, listen, you were allowed to put money in a pre-tax 401k for your entire career. We had this great program in place that we laid out for you that said, put the money away now. You won't pay taxes on it now. It'll grow completely tax deferred, so you won't pay taxes as it grows. But when you're in retirement, you take it out to live off of, and then we'll tax it at that point at ordinary income tax rates. The problem is a lot of people will say, I don't need it. I'm not going to take it. And the government's like, whoa, we had this great program for you, and You said that you would take it later, and now you're not taking it. So we're requiring you to take it. We're requiring a minimum distribution so that now we can get our tax money back. And that's what an RMD is. It's the government saying, all right, time to pay the piper. You've saved all this money, tax deferred. Now it's time to pay it off. So that begins at age 73 under current law. That does rise to age 75 in 2033. So if you do not reach age 75 until after 2033, it'll be 75 as your required minimum distribution age. Okay. Your first RMD must be taken by the time you turn 73, either in that year, or you can wait until April 1st of the following year to take your RMD. So let's just be clear about that. You turn 73 in 2025, and I don't care if it's November of 2025, and you forget to take your RMD or you just choose not to do it, you have until April 1st of the following year to take it in that first year only, okay? That April 1st sort of caveat or extension only applies to the first year. And I think it applies mostly because the government understands that a lot of people don't know about it or forget about it. And in the first year, it jogs that sort of memory that we're not going to penalize you in the first year, but you still have until April 1st. After that, there will be a penalty. If you delay and don't take it until April 1st of the following year, meaning I turn 73 in November of this year, 2025. In 2026, I take it in February because either I forgot or I just chose to delay it. I then have to take a second one by the end of 2026 to make sure I have one for age 73 and age 74. So does that make sense, Zane? So we've got to, if we delay past December 31st of our first year, then we got to take two the next year.
No, that's interesting. That's something I never knew about. And I think RMDs in general, they work pretty tricky. You mentioned a pre-tax retirement account. I think something important to mention to our listeners is Roth IRAs, Roth 401ks would not be affected by this.
Correct. A Roth IRA or 401k is an after-tax account. So we're really only talking about traditional IRAs, SEP or simple IRAs, your employer-sponsored plans, which would be like a 401k, 403b, 457, or an inherited IRA. Now, an inherited IRA has special rules. Now, in today's world, if you inherited an IRA recently, and I'll say recently, like basically within the past 6 years, you have to take it over a 10-year period. So there is a 10-year rule on that, and that creates required minimum distributions as well. They're just different for somebody who's 73.
And that works differently with inherited IRAs compared to other accounts, correct?
It does, yep. And we still have to take that RMD. So RMD is still the word that applies or the term that applies, but it just is going to be done over a different time frame. If you do have an inherited IRA, make sure you know what your required minimum distribution is for that inherited IRA. So let's talk a little bit about how we calculate this amount, right? This is where it can be important to understand that how much do I have, and is this a problem? I have people that have $200,000 or $300,000 in a pre-tax retirement account, and they say, oh, I'm concerned about RMDs. Will that be a problem down the line? And the truth is probably not. And let's talk about what I mean. The way it is calculated is your RMDs are calculated. There is a table on the IRS website to actually show you exactly how it's calculated, and more to the point is what your percentage of distribution will be. So it's based off of your life expectancy. At age 73, there's a pretty set life expectancy, which is 26.5. Now that life expectancy does adjust every year because life expectancy does tend to adjust every year. It's a lot different than it was 10 years ago, simply because people are living longer. Medical technology, healthier lifestyles will affect that number. And then the other number in that calculus is what is the balance of my IRA on December 31st of the prior year. So if I'm 73 in 2025, and I decide I don't want to wait till April 1st, I want to take my RMD this year, I have to look at what was the balance of that IRA on December 31st of 2024 at the close of business. So you look at your statement. What does it say for December 31st? That closing balance is the balance I have to use. And then what I do is I divide it by the life expectancy, which is 26.5. Now, that's a little bit of a calculation that most of us don't want to do, and I completely understand, which is why if you go onto the web or the IRS website, they actually give you the percentages. They allow you to avoid those calculations, and they'll tell you if you're 73, you have to take 3.77% of the balance of your IRA on December 31st of the previous year. Now, roughly, when we talk to people and they say, what do I expect to take? We just tell them it's roughly 4%. And then we do the calculation based on the actual percentage. But the interesting thing is, as you get older, what happens? Your life expectancy gets shorter, right? So if I'm 73, my life expectancy is a lot longer than if I am 90. And if I'm 90, my life expectancy is only a few years. And because it's only a few years at age 90, my divisor is definitely much, much higher, which creates a higher percentage. And now I'm looking at 8.2% that I have to take at 90. So I've got to take 8.2% at age 90, and I got to take 3.77 at age 73. And this goes back to the problem that Stacy had, which was at age 75, I only had to take a certain amount. It was below what I needed to live. I was drawing at least that much anyway. When I turn 90, I have to take a lot more. Number one, because theoretically my account has grown. So it's a bigger balance, right? It's a bigger numerator that we are dealing with. And then also my age has gotten to the point where now I have less life left. So that denominator is getting smaller and smaller, creating a larger percentage.
And here's hoping your account balance goes up as well. I know it's not a good thing to think about your life expectancy, but having a large amount to take from your account is always a good thing as well.
And it should go up. No guarantees, of course. Nobody's going to guarantee your account balance will go up over time. But even if you are distributing, and specifically if you're distributing at the required minimum distribution rates, we would expect typically that your account balance would go up. Now, that's going to get harder and harder as you get older. If you have to take 8.2% out at age 90 and you're modestly conservative in your approach at age 90, there's a good chance you're going to be distributing more than the growth of the account, but probably not terribly much. So that's how it's calculated, and it's something to consider in the sense that we may start at a RMD now that is not too terribly troubling, but over time it's going to get to a point where there's just so much money that I've got to take. And when I have to take more money, what I'm doing is I'm losing control of my income tax bracket. When I lose control of my income tax bracket, that creates problems. Let's talk about that. First one is tax bracket alone is a problem. If the money that I was living off of was typically taxed at 12%, 22%, 24%, those are relatively low rates that we're relatively comfortable paying on the federal side. But if my RMDs get so large that now I'm ticking over even into the 32% range, now we're getting to a point where our money's taxed at a pretty high rate, and that can be a problem. The other ancillary effects that higher income has that might not be thought about is your Medicare premiums. We talked about Medicare IRMAA in the past on past podcasts, and IRMAAs is the incremental increase of your premiums based on your income. And those income brackets, they're not low, but they're not terribly high either. So if I'm now pushing into $250,000 in income or something like that, I'm certainly going to be pushing into IRMAAs. Depending if I'm single or married, I still will have an IRMAA, but the IRMAA might be much higher if I'm single at that point. Having those IRMAAs are just purely an additional tax. I would be getting the exact same Medicare program at a much lower cost if my income were lower. And then lastly, Social Security taxation. Social Security is a really efficient way to earn income from a tax standpoint. Okay, Social Security is taxed very efficiently. However, as I'm reactively increasing my income because I'm losing control of my bracket, my Social Security is going to be taxed at a higher and higher level. And that just, again, going to trigger more taxes that are just completely out of our control. So that can really be a problem for sure.
And I think that's something not a lot of people think about, really, their tax bracket going up, because when you think of a required minimum distribution, you really think, why don't I just take all my money out now? What would happen then? And, the answer is your tax bracket would spike up, and so would your Medicare premiums and taxation on your Social Security.
And it's why we are such big fans, and we've talked about this in the past, of doing Roth conversions. And we've got a prior podcast on Roth conversions and why they're important. And this is the reason why. If we can create some tax diversification in our distributions, meaning, yes, we do have a big IRA, but we've converted over the years, and half is in Roth, and half of the IRA is in pre-tax. Now we can draw some from pre-tax to satisfy our required minimum distributions and some from Roth to meet our lifestyle needs and keep control of our tax bracket. And that's the key. Think about a $3 million total IRA that we can convert $1.5 million over a period of 10 years. When it comes to RMD age, now we only have to draw an RMD on 1.5 million. It's not a terribly large amount of money. And if we need any more, we can pull it from Roth to manage our tax bracket and keep all these IRMAAs and Social Security tax and brackets and things like that all under control.
Now, Ryan, I was talking about taking out your RMDs all at once, and now I'm going to ask you the opposite. What if someone has an RMD and they just decide, hey, I'm not going to take my RMD? What would happen then?
Yeah, it's a pretty common mistake because a lot of times people just don't even know the rule, especially if you're not working with an advisor. If you're doing it yourself, there's a good chance you're going to miss an RMD. And if you do miss an RMD, there is a 25% penalty for it not being withdrawn. It can be reduced to 10% if it's done pretty quickly. So if you miss it by a week or a month, you can fight and have it be a 10% penalty. But I have heard stories of people who, if you miss it for the first time because you just didn't know about it, and then you took it, you receive the penalty, and you fight it, you might actually get a waiver of the penalty. I'm not saying that you should plan on that. I'm not saying that you should do it intentionally. But if it does happen to you, just know it's not the end of the world. Definitely make your case to the IRS that it was completely unintentional, that you did it by accident, and that they might waive that penalty. But clearly a 25% penalty, if you do it consistently, you're not going to get a waiver. You're not going to get a break. It will be a 25% penalty, and a 25% penalty is not something any of us should be dealing with on top of the tax we're already paying.
Exactly. And 25%, even 10%, that's in essence, that's my money. I wouldn't want that going to waste. And I don't want to give Uncle Sam any more of what I'm already giving him.
That is true. That is true. Uncle Sam does not deserve any. We want to pay what we owe, but we don't want to leave a tip. So let's talk about some opportunities that we can use RMDs for to turn them into a positive. So first and foremost, use your RMDs to fund your lifestyle. Right? As you hit RMD age, just build those into your income calculations. Most people we work with have Social Security. If they're 73 or older, they have RMDs. So those are foundational to say, okay, we know those two income sources are coming in, and then what do we build from there? So you can use them for spending, you can use them for travel. If you don't need them because, again, you're drawing more than you need, you can start gifting them to family, friends, loved ones. But build them into your retirement cash flow instead of viewing them as an obligation. And I do want to be really clear because I often get this strange question from people that say, I took $100,000 out of my retirement account this year and my RMD is 45. Do I need to take another 45 to satisfy my RMD? And my answer is no. You don't need to specifically earmark a distribution as an RMD. You just need to hit that minimum level. If you've already taken $100,000 because you've taken something like $8,000 a month in income over 12 months, then you've satisfied your RMD if it's only $45,000, right? We only need to make sure we're withdrawing $45,000 from the account over the course of the year. And it does become a recurring question that I get a lot is not understanding that the required RMD is just the minimum. You can take more if you want. You're welcome to take it. You're welcome to take it as income. It is available to you to take. You just have to make sure you satisfy that amount at some point throughout the year. Next is give strategically. So once you turn old enough that RMDs are now something that needs to be dealt with on an annual basis, there's an opportunity to distribute called qualified charitable distributions. So if you have charitable inclinations, we can use a QCD to say, instead of taking money out of my IRA, paying tax, and then gifting it to charity, I may or may not get a deduction on that charitable gift, depending on a lot of variables, right? Do I take the standard deduction? Do I take the itemized deduction? Am I over a certain threshold on my income levels? There's a lot of things that will determine if I can deduct that charitable donation. However, if we do what's called a qualified charitable distribution, meaning we take our charitable contributions right from our IRA, literally write a check from the IRA account to the charity, and we don't touch it, it goes right to them. That's called a QCD, and that's 100% tax deductible. Satisfies your RMD and gets money out of your account without triggering taxes. Of course, it's got to go to charity, so you don't get to benefit from it. But if you're not using it anyway and you're gifting to charity anyway, it's a great way to do it, great way to get around the RMD in a tax-free manner. Let's talk about making sure that we're supporting our tax efficiency. So if we do have higher RMDs and we have big taxable accounts, as an example, we could do something like tax loss harvesting to sell some losses in the account to offset some of the income. So taking a look at that and understanding that there are ways to do tax loss harvesting. You really can only offset $3,000 of ordinary income, but that is one option to supporting that tax efficiency and taking losses in years that we have them available to us. And then last, my favorite strategy is an ounce of prevention is better than a pound of cure. If we are years away from RMDs, if we're years away from 73 or 75, depending on your birthday, then we want to start doing Roth conversions if we have the ability to do it. By doing Roth conversions, we take this burden off of our shoulders. The more we can convert, the less we can keep our pre-tax 401ks and IRAs from compounding. That's really the problem, is the compounding. We've done all this great calculation. A lot of people on this podcast know the power of the compounding. And what we're doing is we're compounding these large accounts in late years when they're growing at 6, 7, 8 or more percent a year, and they're $2 million accounts. That creates a tremendous amount of growth on a dollar basis. And that's fantastic. That's what we want. That's what we created. But if we can convert a lot of that money and prevent that compounding so that now it's starting to grow and compound in a Roth, that there's a huge value in that down the road when RMDs get serious and make sense. Let's look at Roth conversions for sure.
And no RMDs on Roth. That's my money. Money that moves over from an IRA to a Roth would be my money because I already paid the tax in the IRA when I first deposited it.
Yeah, it's a great point. And I like to think of it as two treasure chests. Both have treasure in it. When I open one treasure chest, it might have 100 gold pieces in it. But by the time I get it all out, it's only going to be 70. The other treasure chest has 100 gold pieces, and that 100 gold pieces is mine. That's how we want to think about it. And the funny thing is, even in our financial planning software and a balance sheet, a Roth IRA and a pre-tax traditional IRA are treated as the exact same dollar amount, but they're clearly different values. So we need to make sure we understand that.
I think of it like giving a bully your lunch. You're going to have to give it either when you come into the cafeteria or when you leave. It's a weird way that I think about it.
Yeah, either way, you're not eating though, right?
Yeah, either way, someone's getting your lunch.
Yeah, that's right. Either way, the bully is getting their share. So let's talk about common pitfalls. Just make sure you don't forget that first year. So if you are near 73, make sure you mark your calendar. In that first year, you have to take that RMD. I really don't recommend as a planner that people wait until April 1st of the following year or wait till the following year at all. Triggering 2 RMDs in the following year doesn't make a lot of sense unless there's a good reason to do. Maybe your RMD is small. Maybe you do have a big need, a home improvement or a big vacation, a car purchase or something that following year, and you want to do 2 RMDs to get the money for those things. That's where it can make some sense, but typically we don't want to do that. Taking from the wrong account. Each 401k requires a separate RMD. That's not true of IRAs. You don't have to draw it from different IRAs, but in a 401k, if you have 2 401ks, you've got to draw RMDs from both 401ks. Okay, so make sure that you're doing that and not missing that because that can be a problem. Ignoring how RMDs can raise your Medicare premiums. We talked about that. The IRMAAs can be really powerful in a devastating way if you're pushing into those high IRMAAs. Literally, your Part B premiums can go from something like $180 a month to $500 a month if you're not careful about what your income levels are. And assuming Roth IRAs have RMDs is another common pitfall. They don't. You do not have to take RMDs from Roth, so they are off the table.
And here's a quick question. So if you're, say hypothetically, you're still working at RMD age and you had a 401k, would you have to take money out?
That's a great question, Zane. And really the short answer is maybe. It depends. I would say just plan to do it. But effectively the way the rule works is if it's a 401k that is not with your current employer, then yes, you have to take it. If you're working for an employer that is offering a 401k, and as long as you're not a 5% owner of that company, then you don't have to take it. You can wait until after. But I would say be careful. There's some nuance there. So I would just plan if you're working at 73 to take those required minimum distributions, but talk to your financial professional and make sure. Let's talk about the things that we can do, our action steps. First, confirm your RMD age and due date. So depending on how old you are now, for a lot of people listening to this podcast, it'll be 73. If you're younger, it'll be 75. As you get closer and turn RMD age, make sure you're looking at your total balance and projected RMD amount. Decide monthly, quarterly, or annually, what is your withdrawal schedule? And it's something we ask our people twice a year when we meet with them. Do you want that RMD every month if you're not taking? Do you want it twice a year? Do you want it all once at the end of the year, like a holiday bonus type of thing? And it really is personal preference. Explore Roth conversions or QCD, qualified charitable distributions, as opportunities to alleviate the RMD concern and problem. They're great strategies. Roth conversion especially, it solves a lot of problems, but RMD is one of the main ones for sure. And then just automate those RMDs to avoid missing the deadlines. For the people working with Synergy, it's not a problem. Come end of November, whatever RMDs are remaining, we just distribute them automatically. We send them right to their checking account. They'll get it. We do not want anybody paying a penalty. We don't want anybody missing. It's never happened in our history, and I don't expect it ever will, but make sure that you're doing the same. All right, ladies and gentlemen, that's it for today. Remember, if you like our podcast, if you like the information that you have, make sure you slam that like sign and make sure you give us the thumbs up. Make sure that you pound that subscription button. We want you getting all the latest information. We have a podcast coming out once a week. We want to make sure that you're getting all the updated information that we're putting out there, and you don't want to be behind on that. And in the meantime, folks, keep learning, keep planning. We'll see you next time.
Thank you for listening to Retirement GPS, navigated by Zenergy. To explore today's topic further, visit our blog mile markers at zenergyretirement.com/blog, where we offer detailed strategies, examples, and downloadable tools to support your retirement journey. Follow us on LinkedIn, Instagram, and Facebook at Zenergy Retirement Planning for weekly insights, checklists, and planning reminders. If you found this episode helpful, please subscribe, leave a 5-star review, and share it with someone planning for their future. Until next time, keep navigating toward a confident retirement. This podcast is for informational purposes only and is not intended as investment, legal, or tax advice. Listeners should consult their own financial, tax, and legal advisors before making any decisions. Zenergy Retirement Planning is a registered investment advisor located in Red Bank, New Jersey.